Look, I'm going to say it that everyone's sitting on the sidelines right now waiting for the perfect moment to buy or sell. Now, some of you may be making the biggest financial mistake of the decade. I don't know, is it you? I'm going to show you why that could be a possibility in this video, because the October 2025 market data just came out, and there's a window opening right now that most people are completely blind to, but it's not going to last. Because here's what's happening. There's a gap between mortgage rates and Treasury yields. That's been artificially wide for years due to market fear, and it's finally starting to narrow. Whew. And when it closes, it will, and I know it will, we're looking at rates potentially dropping way below 6% into the 5s, definitely by the end of 2026. There's been reports about this. I'm going to show you today. But the catch is, by the time everyone realizes this is happening, then you'll be competing with the masses again. Inventory will tighten, prices will surge, and I feel the opportunity will be gone. So in this video, I'm going to show you the exact metric to watch, the timeline of when this shift is going to happen, and some simple strategies, okay? So if you're thinking buying, selling, or maybe you're a real estate agent watching this and you're trying to close more transactions, get more clients, you can't afford to miss this. Well, let's get to it. I always like to start out looking at where we're at right now. Let's look at that first. Paint that picture of that, because the housing market in October, this past month, it kind of was creating a really unique situation. I don't know if we'll see that again for a long time. Take a look at this graph. Get this. For 5 consecutive months now, we had over 1 million homes on the market. And if you're following along, that's pretty big compared to what it used to be. Now, we haven't seen inventory numbers like that since the winter of 2019, before the pandemic turned everything upside down. So we're still in a seller's market, in my mind, but that's going to change. And here's where it gets really interesting. Take a look at this. In August 2025, over 20% of listings had price cuts. 1 in 5 homes. Sellers are sitting there scratching their head like, where did all the buyers go? Why isn't my house selling like my neighbors did in 2021? Well, basically probably because they're overpricing it and they're not staging it, thinking like anybody's going to come buy their crappy home because they want that price. It doesn't happen anymore. So if you're a home seller, the real deal, I know you don't want to hear it, what your neighbor got for their home in 2021 is irrelevant to what your home is worth today. The market is just changed. It fundamentally has changed. Take a look at this graph. Oh my God, we've gone from 6.5% year-over-year appreciation in January 2024 down to about 2.3% by July. That's the numbers I have right now through July. But here's what most agents really won't tell you, is because they don't understand it. They don't understand it. They don't talk about this stuff. That's why I like to talk about this stuff. That's why I'm taking a break from all that stuff and really talking about the market, because the slowdown, guys, it's healthy, it's sustainable. What we had before was a bubble inflating in the last 4 years. What we have now is a market finding its footing. And here's the real deal. That's what you get here. That changes everything. The market is completely fragmented right now. Why am I saying fragmented? Because if you look at this graph, let's look at Cleveland down, but Hartford is up. I think the East Coast, Northeast Coast, like where I'm at in Pennsylvania and above, is really hot still. Tampa's correcting after 70% pandemic gains. You can't sustain that. Boston's still holding steady. I know my area is holding steady. So what does that mean? What it means is that national headlines are useless. Don't get caught up in that. Someone on TV or on YouTube talking about the housing market crash. It's not really talking about anything, really. They're just trying to get you to watch their videos. There's no single housing market anymore. It's your market. It's your neighborhood. Got it? It's your street, down to the little minute things. And the real deal is that if your agent's giving you national statistics and generic advice, they don't know what they're doing. You need someone who understands your micro market, period. That's why when I vet agents to help you sell your home, that's what I do with my YouTube fans, I can help you with things, generic things, staging, marketing, pre-home inspection, pricing, more for the agent. Things like that. Strategy, I can give you strategy, but the local agent's going to give you metrics, and that's what I look for when I look for agents to help you, because everything else is teachable, all right? Go to Real Deal Agent, all right, realdealagent.com. Next, what about the Fed? And what does all this mean when they hear this talk about the Fed and this and that? Because it kind of starts there. I'm going to try to make this interesting. I know this is like a boring economic class stuff. I know my videos are more informational about how to do things, but you got to listen to this. Wherever you are, you need to listen if you're selling your home next year, because everyone keeps asking, when are rates going to come down? Like that's going to change anything. And if you're asking that question, why? What does it matter? Do you think that because the rates are down, people are going to pay you more money? Possibly, but if your home isn't staged and isn't priced right, and you don't have a strategic negotiator on your side, it's not. Has nothing to do with it. Stop waiting for the Fed to do something. So first, you need to understand the Fed doesn't set mortgage rates, right? That's not what they do. What they set is the federal funds rate, and that's really a signal from the broader economy. The Fed has two jobs, really keep inflation under control and maintain maximum employment. I mean, that's in a nutshell. That's it. They try to avoid recession while making sure prices don't spiral out of control. Supposedly, that's their job, right? So what are we seeing now? I got this graph for you about inflation. As of this graph, it shows that inflation is elevated around 2.9%. I guess they say it around 2%. It is stabilizing, it's good. It's not quite there yet. And that depends on who you're talking to. Everyone has their different political mindsets about this. But if you look at this graph, unemployment is around 4.3%, which is great. It's a little higher than you like to see, but here's the real concerning part, that job growth is kind of stalling in some areas. So if you look at this graph, real quick, that's what they're saying. It's job growth is stalling. That's where this article I got my information from. So, but if you look at the graph, we went from adding 800,000 jobs, 900,000 jobs per month back in 2021 to barely scraping by under 100,000 in some recent months. So they're saying that's a red flag. Now, I think all these numbers, depending on who you're talking to, is different. But this is the numbers I'm working with today. So to make matters more complicated, when this report came out, we were in the middle of a government shutdown, which means the Fed might not have had access to all the economic data they normally use to make decisions. Who knows? They're literally trying to navigate the economy with some of their instruments turned off. But here's what really gets me. According to LendingTree, check this out. Nearly 2 out of 3 Americans think a recession is coming. It's not about what they're doing or not doing, it's about what people think, but because of all this noise and traffic and fake news out there in the world. And 74% say that world news and current events are affecting their financial decisions because of all the things. Here, one channel says this, another one says this, another political activist says that. Think of what all that means. People are scared, they're not buying, and they're not making big purchases as much. They're kind of sitting on their hands waiting for something, and when everyone's waiting, that can actually create the problem that we're worried about. It becomes like a self-fulfilling prophecy. And exactly why knowledge is power right now, when you understand what's actually happening, versus what people fear is happening. You can make smart moves while everyone else is frozen. If you can do it, if it works for you. I just had my home seller, Linda, so her mom's home was an estate, and she was living there. She moved out, found her a home, and the market said, oh, it's never going to sell. We did our thing. We Dianized the house, staged it, did all the things to it, painted, put the hardware, painted cabinets that were like from 1960s. I priced it at $420 because it had a 2-car garage and it was on a nice lot, but that was a great price. And it brought in hundreds of people, tons of showings. What did I get? $470. So in our area, if you price it right, people are still out there buying. They still want to buy homes, okay? They still want to buy homes, no matter where the rates are. People are out there. And the bigger problem is when the Fed makes a move or talks about a move, mortgage rates and financial markets, they just respond. Sometimes they respond before the Fed even acts, just based on expectations. And that's what happened in September when the Fed started their rate cutting cycle. Okay, enough of that. What's the one metric that changes everything? Well, I think this is the good stuff. I think this metric that I talked about in the beginning could literally save you thousands of dollars. You gotta take a look at this graph, because for over 50 years, there's been this relationship between the 10-year Treasury yield and the 30-year mortgage rate. They move together. When the 10-year Treasury goes up, mortgage rates usually follow. When it goes down, mortgage rates usually come down. And historically, there's been like an average spread of about 1.76 between them. So if the 10-year Treasury is 4%, mortgage rates would typically be around 5.76%. That makes sense, right? But what happened was, during all the uncertainty over the last few years during the pandemic, that spread got so much bigger. It went from 1.76 to 2.76. That's 1 point. Came down to 2.59 as of late September, this past month, and sitting about 2.1. That spread, well, it's basically a fear gauge for the market, and that's what lots of uncertainty, pandemic, inflation, economic chaos, political stuff going on, government closed, geez. Lenders get nervous and they widen their spread to protect themselves. I don't know what's going to happen, so I'm charging more just to be safe. But as things stabilize and the path forward becomes clearer, that spread narrows. And guess what? It's been narrowing and it's forecast to keep narrowing into 2026. All right, yay. But why is this huge? Right now, take a look at this graph. So important. You guys, this is boring stuff, but you have to listen to it. And with the 10-year Treasury at about 4.2 and the spread of 2.10, we get a mortgage rate of 6.3. But what if that spread went back to the historical average? Woo! Just back to the normal and the Treasury stayed where it was. We'll be looking at mortgage rates around 5, 5.5, 5.96, whatever, under 6. They're going to be under 6. I guarantee that. The kicker is the 10-year Treasury is also forecast to come down. So you've got two things working for you right now. You've got the Treasury dropping and the spread narrowing, and that's a double benefit pushing mortgage rates lower. I don't know if it's going to be as low as 3%, but at least it might get some people off the fence and open up more inventory in the market for these buyers. So the forecasts are showing rates could end 2026 somewhere in the low 6% range, with Fannie Mae even predicting 5.9. It's going to be lower, I think, but now that's not guaranteed forecast, just educational guesses. Trend's clear. Here's what you need to understand. This is happening right now in real time. When mortgage rates dropped in late August and early September, we saw buyer demand pick up. I know this because my lender, Krista Larry, who I work with for 30 years, she told me purchase application increased. She told me that agents were starting to feel momentum again. I don't really change my way of being based upon what's going on in the market. So I'm always the same, aggressive and out there. But there's this great insight from One Real Mortgage. They say that with expectations growing for a rate cut at the Fed's next meeting, this could be just the beginning of a stronger housing market heading into the fall. And they're right. Take a look at this. When rates move from that 7% down to 6.5 and below range, buyers came off the sidelines. That was amazing. What's the opportunity window? I'm going to explain that to you. That's why timing really means a lot right now, because we're in this really unique window where three things are happening at once. We have inventory is high, but over 1 million homes on the market. Buyers have more choices, but not as high as it was, but it is higher. Sellers are motivated with 20% of the listings having price cuts. There's room to negotiate, And third thing is competition is relatively low because most buyers are sitting on the sidelines waiting, scared about the economy, worried about recession. And here's what's coming. Mortgage rates, as they drop, continue to drop through 2026. More and more buyers are going to jump in. And when they do, you're going to see inventory tighten, competition increase, and prices start accelerating again. But I think if the rates go down, I think the inventory actually could come up because the silver tsunami might start. These home sellers who have been in their home now 6 years since the pandemic, they're going to want to start moving. If the rates hit, like say 5.5, and it's going to be all over the news, everybody's talking about it, guess what? It's going to be crazy out there again. You can put your home on the market, and then more buyers will be out there, and then they'll be competing against everyone again. Maybe back to multiple offers. I have had multiple offers. I have not stopped having multiple offers, but that's another video. Anyway, so right now you can position yourself when inventory is a little bit higher, competition's manageable, and then the rates drop further, you can refinance, all right? So you kind of get the best of worlds. I'm not saying that's what you should do, but you should think about going on the market, getting your house on the market. There are buyers out there. You can always capture the lower rate later now. If you're a seller right now and you're sitting on your hands waiting for good old days of 2021 to come back, you're just missing the reality that we have actual buyers in the market right now. Qualified, ready to go, looking for homes. I got like 6 buyers from my last listing calling me. Now they don't want to overpay as much, so we need to price realistically based on current market conditions, not based on what somebody got 3 years ago. So what's ahead? If you're still watching this video, then you like numbers, because let me tell you what's ahead. Here's what gets really interesting. Okay, Fannie Mae, Home Price Expectation Survey, polls about 100 economists and industry experts. Take a look at this graph. Wow, home prices are expected to grow over the next 5 years. Even the pessimists are predicting growth. The most pessimistic one is forecasting about 4.9% cumulative growth from 2025 to 2029. The average prediction is around 15.3%. The optimists are 25.8%. I personally think we'll land somewhere in the middle, 15% over the 5 years, which works out to be 3% per year. That's what a normal sustainable appreciation is, what we used to have. Not the crazy 20% year over year things that were happening the past few years, but solid, reliable growth. And total home sales are forecasted to increase. Take a look at this graph. Come on, guys. We ended 2024 at about 4.7 million sales. We're looking at about 4.82 million for 2025. Pretty flat, because it was a kind of flat year. But in 2026, the consensus forecast is 5.2 million. That's an increase of over 440,000 transactions. More inventory, easing mortgage rates, moderating prices, and improving affordability all add up to more transactions. And more transactions mean more opportunity. Whether you're buying, selling, or working, say you're a realtor listening to this, there's going to be opportunities. So speaking of realtors, I need to take a pause here because I get asked constantly, do you know a good agent in my area? Yes. If you don't, I'll look for it. Finding the right agent, that was really hard. There are a million people with real estate licenses around, but finding someone who actually understands what we just talked about, God, someone who gets the Fed, understands the spread, knows how to read local market data, and can explain it clearly. Very, very rare. That is why I created my Real Deal Agent Referral Program. Just go to Real Deal Agent, so simple. I'll just personally connect, see if I can help you, 15-minute call. And then if you're in, you said, yeah, find me somebody, then I'll find you somebody. I'm not gonna be random referrals or agents I trust who understand the market. We're going to educate you and fight for you. I can tell you it's not easy. I have to jump in all the time. I always jump in because it's just kind of out there, out of the box. It's very hard to find somebody like that. But whether you're buying or selling, relocating, investing, just go to realdealagent.com. It's free, zero obligation. And I'll save you so much time trying to figure out who to work with, of course, money, because when you list with the wrong agent, you lose thousands of dollars. But the real truth is, in a market like this, having the right agent isn't just helpful, it's kind of the difference between winning and losing, between getting a great deal and overpaying, between selling in 30 days versus sitting on the market for 6 months. Remember at the very beginning when I said there's one metric that could save you thousands or cost you everything? It's the spread. The spread between the 10-year Treasury and the mortgage rates, okay? So I talked about it at length. Just keep an eye on it, okay? It's expected to continue to narrow as fear subsides and the economy stabilizing. Just a little 0.1%. If it just narrows, by a little bit, mortgage rates are going to drop. And every time mortgage rates drop by even 0.25%, boom, monthly payments drop significantly. How does that work? Well, in a $400,000 home, the difference between 6.5 and 6 is about $125 a month, $1,500 a year, and over 30 years, it's $45,000. So when I can say this metric can save you thousands or cost you thousands, I'm not exaggerating. So if you understand it and you act while the window is open, you win. If you ignore it and wait until everyone else figures it out, you lose the leverage. Guys, I'm going to leave you with this one thing. Most agents know what's happening. They read headlines. Good agents understand it. They look at data. But real deal agents, great agents, and informed homeowners, they connect the dots. They see the bigger picture. They understand cause and effect. And that's what I'm doing here, connecting the dots so you can move with confidence in 2026. Because we're heading into 2006, I think, with momentum. Rates are easing, demand is picking up, and opportunity is returning to the market. It won't be perfect. It never is perfect, but for those who are informed, it's promising. So keep learning, stay proactive. Watch my next video. It's a great one. Your Home's Silent Money Leaks. It's a powerful companion to what you just learned. It's the perfect follow-up to this one because it reveals the overlooked maintenance issues, upgrades, and small inefficiencies that quietly drain thousands of dollars before you ever list your home. Check it out.